On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, I hope you're all well. An extra episode this week. I was asked to write a summary of where the economy's at for an organisation. I was very happy to do that, and I thought, well, I may as well record that and share my thoughts with all of you. So here's where we're at. It has been a very difficult couple of years for most New Zealand businesses. So if you're a business owner or if you're an employee, I'm sure many of you would have felt that. It has been slow and it has been difficult. We've been in recession. The economy has contracted for 7 of the past 8 quarters on a per capita basis. Per capita means per person. I like to look at that when I'm looking at our growth profile because it means you're backing out some of that strong migration that we've seen in recent years. Otherwise, you end up sort of having the water muddied a little bit by looking at the economy and saying, well, it's growing, but if that's purely driven by population growth, sometimes it is a little bit artificial in a way. So I like to boil things down to what's happening on a per person basis, a per household basis, a per capita basis. I think that gives a much more accurate picture of how things are for us. And it's not fantastic, is it? 7 out of the past 8 quarters, we're down. And the other quarter, we were flat. So we didn't grow, we were flat. So you may as well say 8 quarters without growth. So that's 2 years of recession, essentially. That challenging backdrop was really highlighted by the labour force report that we got this week, the unemployment rate rising from 4.8% to 5.1% in the December quarter, end of last year. And while that was in line with expectations, it was the highest that we'd seen since September 2020 when we were in the middle of COVID and lockdowns. So slightly above that 25-year average of 4.8%, but not going in the right direction. But more encouragingly, I am optimistic. I am glass half full about what is happening in this year, 2025, and where we're headed for 2026. The economy will improve, and it should prove to be a much better year than last year, or the one before that, 2023 for that matter. After increasing the OCR, the official cash rate, to 5.5% in 2023, the highest since 2008, the Reserve Bank last year reduced it 3 times over the latter months of last year. So it's now sitting at 4.25%, and we're expecting a 50 basis point cut later this month. That would take it to 3.75%, and beyond that, we expect 2 or 3 more cuts. So the OCR will probably settle at around the 3% mark by the end of this year. The 1-year mortgage rate has already fallen quite sharply. It peaked at 7.3% about a year ago, and today it's sitting at about 5.5%. So that's a big fall, not quite 2%. It's actually fallen more than the OCR's fallen, and that's because markets look ahead and the banks are pricing their mortgages in anticipation of what's coming as well as what's behind us, and wholesale interest rates also have a big impact on mortgage rates. It's not just about what the Reserve Bank is doing. So you've seen that big fall in mortgage rates already from the peak. I think they will go a little lower, but I also think that most of the decline is behind us now. So there's probably a little bit more to come, but most of that fall has been. So if you've got a mortgage coming up, like I have, and you're thinking about what should I do, when should I refix, I would probably leave it as late as possible. I'm going to leave mine to the last minute because we've got another OCR cut coming up. You might see a bit of movement then. I see one of the banks has actually got a 3-year rate that's under 5% now, 4.99. I think that's Westpac. That is pretty good. So there might be a bit more to come from the other banks, from the other terms, but don't get too excited that there's a whole lot more to come. I think most of that decline has already happened. But the declines have been big. It will take the pressure off households. It will increase disposable incomes, take the pressure off budgets, and it will boost economic activity. There's always a lag as OCR and interest rate changes, mortgage rates and so forth. There's always a lag as that flows through to the economy, and it's typically as long as 18 months, give or take, because as soon as the OCR comes down, then the mortgage rates come down. I don't feel that immediately, do I? I only feel it when I go into the bank, refix my mortgage at a lower rate. That's when I've got more money in my pocket, and that's when I can actually spend more. So it does take a bit of time. However, this time around, we won't have to wait as long as we usually do, because borrowers have all opted for shorter mortgage terms over the last couple of years. Everyone's gone for the 6-month rate, maybe the 1-year rate rather than the 2-year or the 3-year rate. And that means when the OCR comes down, when the mortgage rates come down, it will take a shorter time frame for that to actually hit people's budgets and have that impact on the economy. So that's good. We should start to see the benefits of last year's rate cuts and the ones that are coming up over the next 3 months, 6 months, 9 months, certainly. Confidence amongst businesses has really bounced on the back of what you're seeing out there in terms of mortgage rates and with the OCR cuts, and firms are definitely looking forward to a more buoyant period ahead. I watch the ANZ Business Outlook survey closely, and I watch the own activity measure, which is a very useful leading indicator for where economic growth is headed. That hit a 10-year high in December. Now, that doesn't mean things are the best they've been in 10 years, but it means businesses are a lot more optimistic about things getting better, much more optimistic than they have been for many years relative to where they're at. Something else that's worth taking note of is where the currency has been going of late. Because our Reserve Bank has been cutting interest rates more aggressively than many of its international peers, a byproduct of this has been a lower New Zealand dollar. So the Kiwi dollar is trading at around US 56 cents right now. That's the lowest since 2009, and it's about 15 odd percent below the long-term average against the greenback, which is about 65, 66 cents. It's also weakened against the Aussie dollar, against the British pound over the past 6 months, not nearly as much as it has against the US dollar, because part of that story is that the US dollar has been very strong. So the US dollar has been going up against everybody, not just us, but we have softened against the Aussie dollar and the British pound too over the last 6 months or so. Currency weakness is a real double-edged sword because it's good for the competitiveness of exporters, so dairy farmers and other exporters. They do well when the currency is weak because it means that they can get more for their products for the same price on the international markets, or they can actually price their products a little bit more competitively, a little bit cheaper, but end up with the same amount in New Zealand dollar terms. So it's great for the export sector, good for tourism and so forth. But the other side of that coin is that it means many imported goods, things like fuel and everything else that we have to bring in from overseas, those things become more expensive, which isn't good in terms of the cost of living and the inflation backdrop. So currency weakness depends on your perspective, whether it's good or bad. One sector that has been benefiting more than most is the dairy industry, and this is a real good news story for the New Zealand economy. Global dairy prices rose 18.9% last year, 2024, and this year they're up again. They're up another 3 or 4% so far this year, 2025. So they're sitting at 2.5-year highs, the highest we've seen since the middle of 2022, late 2022. Dairy prices are quoted in US dollars as well, so that lower currency, that lower Kiwi dollar, has helped push prices even higher. And that's why Fonterra's got a milk price forecast range of between $9.50 and $10.50, and that's a midpoint of $10. So if that eventuates, or if it's exceeded, because it could even be higher than that, that would be the highest we've ever seen, and it would be above that previous record from the 2021-2022 season of $9.30. So that will deliver a really strong growth impulse to many of our regional economies where dairy is a big part of the local economy, and you've got all of those shops and services that hang off the dairy sector. So this year is expected to be a much better one for the economy, but there's still lots of risks out there, and one of the most obvious for us is the potential for policy uncertainty and geopolitical stresses offshore. US President Donald Trump has threatened to impose harsh tariffs on numerous countries since taking office. We've seen them on China, on Canada, on Mexico. I expect Europe to be in the firing line at some point. And while Trump has softened his stance in some of those cases, this really could be a sign of things to come. He's pro-growth, he's business-friendly, he wants to reduce regulation and red tape. All of those things are positive for the US economy, which is the biggest economy in the world, and that's a good thing from the perspective of global growth. However, tariffs and trade tensions are not good for global growth. And Trump is very much willing to accept short-term economic pain, short-term financial market pain, if he believes that some of these moves will deliver a better long-term outcome for America. So here in New Zealand, we're not directly in the firing line, but we will be impacted by any flow-on effects. Remember, China's our biggest export market, and we won't be immune to a further slowdown in that part of the world. China is the world's second largest economy, and we do need to keep a close eye on what's happening over there. In terms of goods exports, I think you've got the US and Australia that are sort of neck and neck for 2 and 3. And Australia in particular, its economic success is also closely linked to China, because Australia's biggest export market is China. So we've almost doubled up in terms of our exposure there to China, because we get it directly and we get it through our friends across the Tasman indirectly. And as a small open economy that relies on international trade, we must be mindful of these sorts of vulnerabilities. So that's how I'm seeing the economy. I do think this year will be a much better year. I think give it a few short months and you'll see the impact of some of those rate cuts flow through to households, spending and the real economy. But there are some risks out there and we need to be mindful of those too. So thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.